Every major financial crash in the last 100 years has followed the same pattern. Not similar patterns. The same pattern. 1929 followed it. 1987 followed it. 2000 followed it. 2008 followed it. It's a 5-stage sequence that appears months, sometimes years, before the collapse actually happens. Wall Street knows about this pattern. The Federal Reserve knows about it. The people who manage money for billionaires definitely know about it, but you've probably never heard of it. Because if regular people understood what to look for, they'd pull their money out before the crash instead of after. I'm going to walk you through all 5 stages today, and I'm going to show you exactly where we are in that sequence right now. Spoiler, we're further along than you think. In 1929, a man named Roger Babson gave a speech at a business conference. He said 9 words that made him the most hated man on Wall Street. Sooner or later, a crash is coming, and it may be terrific. The audience laughed. Newspapers mocked him. Irving Fisher, the most celebrated economist of the era, dismissed him publicly, declaring that stocks had reached a permanently high plateau. 47 days later, the market collapsed. Fisher lost everything. He died in poverty. Babson made a fortune and went on to found a college that still exists today. But here's what most people don't know. Babson wasn't guessing. He had developed a systematic method for analyzing financial conditions. He looked at credit levels, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 factors, 5 stages. I spent 3 months going through historical records, Federal Reserve data, and academic papers to verify whether his framework actually held up across different crashes. It does, every single time. Let me show you. Stage 1 is the credit explosion. This is where it always starts. Not with greed, not with speculation, with debt. Before every major crash, there's a period where credit expands faster than the economy can absorb it. People borrow money they can't afford to repay. They use that borrowed money to buy assets. The buying pushes prices up. Rising prices make people feel wealthy. Feeling wealthy makes them borrow more. It's a feedback loop that feels like prosperity, but it's actually a trap being set. In the late 1920s, margin debt exploded. Ordinary Americans were putting down 10% and borrowing 90% to buy stocks. By 1929, total margin debt equaled the entire federal budget. Factory workers were leveraged like hedge funds. In 2007, it was mortgage debt. Banks created exotic instruments that let people buy homes with no money down. They packaged those mortgages into securities and sold them to pension funds. The leverage was hidden, but it was everywhere. In 2000, it was corporate debt. Companies with no profits borrowed billions to fund expansion. They used stock as collateral. When stock prices fell, the whole structure imploded. Now look at where we are today. Official margin debt sits around $750 billion. But that number is a lie. It only captures a fraction of the actual leverage in the system. Add in securities-based lending, where wealthy investors borrow against their portfolios, and you add another $800 billion. Add in the leverage embedded in options markets, where a small amount of money can control massive positions. And you add trillions more in notional exposure. Add in corporate debt, which has exploded to over $10 trillion, much of it used to buy back stock rather than build businesses. Add in government debt, which has crossed $34 trillion and requires interest payments larger than the defense budget. As a percentage of GDP, total debt in the American economy is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't just flashing red, it's on fire. Stage 2 is the concentration trap. Here's something they don't teach you in finance class. Crashes don't just happen because prices are high. They happen because risk is concentrated. When a small number of assets carry a disproportionate share of the market's value, the system becomes fragile. All it takes is one of those assets to stumble, and it drags everything else down with it. In 1929, the market was dominated by a handful of glamour stocks. Radio Corporation of America was the superstar. It went from under $2 to over $500 in a few years. People didn't understand radio technology. They just knew the stock kept going up. RCA made up a huge percentage of the market's value. When it cracked, the whole market cracked with it. In 2000, it was the dot-coms, Cisco, Intel, Microsoft, a handful of tech names. The NASDAQ was essentially a bet on 10 companies. When those 10 rolled over, trillions in wealth vanished. In 2008, concentration was hidden in the banking sector. 5 banks held the majority of derivatives exposure. When Lehman went down, it nearly took the whole system with it. Today, the concentration is staring us in the face, and somehow nobody seems concerned. The top 7 stocks in the S&P 500 now account for over 30% of the entire index. At certain points this year, it's been closer to 35%. Think about what that means. When you buy an S&P 500 index fund, which is what sits in most 401ks and retirement accounts, you're not really buying 500 companies. You're making a massive leveraged bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And here's the thing about those 7 stocks. They're all trading at valuations that require perfection. Not good earnings, perfect earnings. Any disappointment, any slowdown, any crack in the narrative, and the selling will feed on itself. Passive investing has made this worse. Every dollar that flows into an index fund automatically buys more of the biggest stocks, pushing their prices higher, increasing their weighting, which means the next dollar buys even more. It's a momentum machine that works beautifully on the way up. On the way down, it reverses. Every dollar that flows out sells the biggest positions first. Forced selling creates more selling. This is stage 2, the concentration trap. And we're deeper in it than we've ever been. Stage 3 is the smart money exit. This is the stage that makes me angriest, because it reveals how the game actually works. Before every major crash, there's a period where institutional investors, the banks, the hedge funds, the family offices, the billionaires, quietly reduce their exposure. They sell their positions, they raise cash, they buy protection, they don't announce it, they don't warn anyone. In fact, their public statements often say the opposite. They tell you to stay invested. They tell you the fundamentals are strong. They tell you not to panic. And while they're saying that, they're heading for the exits. In 1929, the Morgans and the Rockefellers started liquidating in the summer, months before the October crash. Bernard Baruch, one of the richest men in America, was almost entirely in cash by September. Joseph Kennedy sold everything after his famous shoeshine boy conversation. But the real reason he sold was that he had connections to people who knew what was happening inside the banks. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, hedge funds started shorting subprime mortgages a full year before the crash. Goldman Sachs famously bet against the same securities they were selling to clients. Executives at Countrywide and other mortgage lenders were dumping their personal stock while telling investors everything was fine. Regular Americans kept buying houses and bank stocks. They were the exit liquidity. Now let's look at today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, board members, the people who actually know what's happening inside these companies, are selling their stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying shares of their own company, multiple insiders are selling. Meanwhile, retail investors, regular people, have been pouring money into the market. Robinhood accounts, 401k contributions, passive index flows, record amounts. The smart money is selling. The regular people are buying. This is not a coincidence. This is the pattern. This is how it works every single time. Stage 3 is flashing red. Stage 4 is the liquidity illusion. This is the sneakiest stage because everything still looks normal. Prices are stable or even rising. Trading volumes are healthy. Nothing seems wrong. But underneath the surface, the liquidity that supports the market is draining away. Liquidity is like oxygen for financial markets. When there's plenty of it, everything functions smoothly. Buyers and sellers can transact easily. Prices adjust gradually. Shocks get absorbed. When liquidity disappears, markets stop functioning. Prices don't adjust gradually. They gap. Small sell orders move prices by huge amounts. Feedback loops take over. The crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions. They were trying to cool off speculation. What they actually did was drain the liquidity that was supporting asset prices. For a while, nothing happened, and the market even kept rising. People thought the Fed's tightening didn't matter. Then October came, and when selling started, there was nobody on the other side. The bids just vanished. Stocks didn't decline. They went into free fall because there was literally no liquidity. In 2007 and 2008, the same thing happened. The Fed had been raising rates, credit conditions were tightening, but the stock market stayed high. Housing prices stayed high, everything seemed fine. Then Bear Stearns collapsed, then Lehman, and suddenly everyone realized the liquidity was gone. The market dropped 50% in months. Now look at today. The Federal Reserve has raised interest rates at the fastest pace in 40 years. They've gone from 0 to over 5% in less than 2 years. They've been running quantitative tightening, pulling hundreds of billions of dollars out of the financial system. And yet the stock market is near all-time highs. People think this means the tightening doesn't matter. They think we've achieved a soft landing. They're wrong. The stress is already showing. In March 2023, 3 major banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic. These weren't small institutions. They failed because of a liquidity crisis caused by rising rates. The Fed had to step in with emergency lending programs. They essentially printed money to backstop the banking system while claiming they weren't doing a bailout. Those emergency programs are temporary patches. They don't fix the underlying problem, they just delay it. The Treasury market, the foundation of the entire global financial system, has been showing signs of stress. There have been moments where liquidity in the Treasury market nearly evaporated, the most liquid market in the world, and it's having plumbing problems. This is stage 4, the liquidity illusion. Everything looks calm on the surface. Underneath, the oxygen is being sucked out of the room. And that brings us to stage 5, the trigger. This is the one nobody can predict, and that's exactly what makes it so dangerous. Stage 5 is the event that turns a vulnerable market into a collapsing market. It's the match that lights the fuse. Here's what most people get wrong about triggers. They think the trigger causes the crash. It doesn't. The crash is caused by stages 1 through 4. The debt, the concentration, the smart money exit, the liquidity drain. Those create the conditions for collapse. The trigger just determines when. In 1929, the trigger was the Hatry case. Clarence Hatry was a British financier who got arrested for fraud in September. Nobody in America cared. It seemed irrelevant. But British banks had exposure to Hatry. They had to raise cash. So they sold their American investments. That selling created more selling. Within weeks, the market was in freefall. A minor British fraud case triggered the Great Depression, not because the fraud mattered, but because the system was so fragile that any shock would have done it. In 2008, the trigger was Lehman Brothers. But it could have been Bear Stearns, or AIG, or any number of other institutions. The system was primed to explode. Lehman was just the spark. So what's the trigger going to be this time? I don't know. Nobody knows. That's the nature of triggers. It could be geopolitical, a real escalation in Taiwan, something unexpected in the Middle East, a miscalculation with Russia. It could be financial, a major hedge fund blowing up, a sovereign debt crisis in Europe or Asia, a derivatives accident. And remember, the derivatives market is over $600 trillion in notional value. One major counterparty failure could cascade through the entire system. It could be something in the banking system, more regional banks failing, a run on a major institution, a crisis in commercial real estate that takes down the lenders who financed it. It could be political, a constitutional crisis, a debt ceiling standoff that goes wrong, a loss of confidence in the dollar. Or it could be something nobody is talking about. That's usually how it works. The trigger is never the thing everyone is worried about. It's the thing nobody sees coming. What I do know is this. When stages 1 through 4 are all flashing red, the trigger usually arrives within 12 to 24 months. We've had 4 stages confirmed since late 2024. That puts the window somewhere in 2025 or 2026. Now let me tell you what this doesn't mean. I'm not telling you the market is going to crash tomorrow. Timing is impossible. Markets can stay irrational longer than you can stay solvent. Anyone who tells you they know exactly when the crash is coming is lying. I'm also not telling you to sell everything and hide in a bunker. That's not a strategy. That's panic. What I am telling you is that the conditions which preceded every major crash in the last 100 years are present right now. All 5 stages are either active or imminent. This is not normal. This is not a drill. The question isn't whether you believe me. The question is what you're going to do with this information. Roger Babson didn't just predict the 1929 crash. He prepared for it. While everyone else was leveraged to the hilt, he held cash. While everyone else bought stocks at the top, he bought farmland and hard assets. When the crash came, he was positioned to survive and thrive. Irving Fisher, the genius economist who mocked Babson, lost everything. His fortune, his reputation, his legacy. He spent the rest of his life trying to recover and never did. The difference between them wasn't intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself for what was coming instead of what he wished would happen. You have the same choice right now. You can look at the data I just showed you and decide it doesn't apply to you. Markets always recover eventually, right? This time could be different. Or you can ask yourself some uncomfortable questions. How much of your wealth is in the stock market right now? Not just your brokerage account, your retirement accounts, your pension if you have one, your home equity if you live in a bubble market. How much of that is concentrated in a handful of mega-cap tech stocks? How much of your financial security depends on prices staying where they are or going higher? If the market dropped 50% over the next 18 months, which is what happened in 2008, would you be okay? Would you lose your retirement? Would you have to delay your plans by a decade? I'm not telling you what to do. I'm not a financial advisor. I'm a historian. I study patterns. And the pattern is clear. The people who get destroyed in crashes aren't stupid. They're just unprepared. They trust the experts who tell them everything is fine. They believe the system is more stable than it is. They assume someone would warn them if something was really wrong. Nobody warned them in 1929. Nobody warned them in 2008. Nobody's going to warn you now. The warning is the pattern itself, and now you know it. What you do next is up to you. If this video helped you see something you didn't see before, subscribe and turn on notifications. I'm going to be breaking down each of these 5 stages in more detail over the coming weeks, including the specific data points you can track yourself. Knowledge isn't power. Applied knowledge is power. The crash of 1929 didn't have to destroy so many